Hi everyone, and welcome to this IDC session on financial services in the next normal. Today we want to talk about how financial institutions are shifting gears from perseverance to acceleration in the light of what's going on with the pandemic. My name is Tom Zink, and I'm a research director for IDC Financial Insights, and I'm leading the European financial services research. I wanted to begin today by talking about a framework that IDC has developed over the last couple of months, which we call the recovery curve. And it maps out how institutions are looking at different priorities as we move through the pandemic crisis. Obviously, in the early onslaught of the pandemic in March, April, focus was plainly focusing on business continuity and keeping the lights on. Whereas in the next phase, the focus was really shifting towards value-generating initiatives, really generating as much return on investment on your investments as possible, and to close some of the gaps that are still apparent in the digital channel proposition. After that, and that's the phase that we're entering now, we really see organizations shifting their view and focusing strongly on operational resiliency. And some of the leaders are already moving to the next level, where they are really planning and thinking about how they can future-proof their business for further shocks like the pandemics or other external shocks that might hit their business, and really modernize their infrastructure to set up their business and future-proof their business for what is coming after the crisis and in the continuing recovery. Obviously, there are a lot of different priorities that banks have been driving throughout the crisis. What we clearly see is that, particularly in the early onslaught, the focus was very dominantly on creating digital trust, so focusing on things like security in the picture of the growing cyber attacks that we saw across the world, as well as focusing on fraud, as we suddenly were in a new environment where we had to send thousands of people, of staff home to really ensure that there is no room for fraud. The other key priority that we've seen is obviously banks and insurers investing strongly in building better digital customer experiences. Then there are also a couple of other areas such as digital lending that really showed that we had some weaknesses, and particularly of the light of this new digital ecosystem, in the light of the digital customer interaction that we are driving. And it very quickly showed that the way a lot of organizations go about lending is still very much anchored in the past. And obviously, as we move along, I already mentioned that organizations are now focusing more on efficiency and agility, building and modernizing a modern platform to run their business on, modernizing infrastructure, particularly moving into the cloud and to leverage some of the added attributes that cloud brings to us, such as scalability, flexibility, and speed. Today, I want to focus primarily on the experience, customer engagement, and on digital lending. So let's jump right into what banks have been doing over the last couple of months and some even years. And what we see today is that personalized experiences are something that financial institutions are trying to bring to the market. And we see particularly a lot of activity around giving more actionable financial recommendations to help clients better plan for their financial finances, becoming more actionable also in terms of reminders. So you have a bill to pay, you have to respond here to really help customers also avoid unnecessary fees and penalties. And then there's obviously a strong focus on also driving security by involving the customer in a different way. So a lot more alerts are sent out for suspicious transactions that prompt the customer to confirm that this is really a wanted transaction. We also see the rise of more gamification elements such as spending goals, rewards, discounts, and so on, to really take digital customer engagement to a new level. And lastly, some organizations are also trying to bring sales down to a more personalized level to really identify the right moment when a client actually really needs a financial product the strongest. But the question is really, are all those cosmetic changes that we are seeing today in the customer experience what is needed to really deliver striking and really good customer experiences? And one thing that we found in our research is when we did a consumer survey that European consumers really have very diverse needs. Yet most of the financial institutions go for a one-size-fits-all approach when it comes to digital channels. And this is not really helping them to address the specific needs of those unique consumer banking archetypes. That's how we coined it. And as you can see, this is a European sample. We have identified 5 distinct archetypes that really differentiate different groups or different segments of customers and their expectations and preferences for banking. So you have the urbanites that really strive for very unique banking experience. They look for fancy tools. They want to be on top of what technology can deliver. You have rationalists that basically seek for the best deal at the lowest price. You have loyalists that basically do banking as always. They do more research online, but they still value that human interaction. They want to come to a branch to have a discussion with a human, and that is a very large group, or still the largest group that we've found in our sample. And then you have other segments such as traditionalists that really don't like financial services. So they only interact with the bank when it's really necessary, and they want to be in control of how the bank interacts with them, and they want to have the choice of channel as well. And then lastly, we have the strivers, which are the young people, the millennials, that have a very different view of life. Those are the guys that we saw going out on Fridays to demonstrate against climate change. And they really live and breathe online, but they have very limited trust in banking, given that basically throughout their life, banks, the most they saw of their banks is when they are hit by scandals or when they're causing financial crisis. So really a very different customer segment to engage in, a very challenging one at that. Here I quickly outlined some of the expectations that those segments had. And as you can see, these are very different when it comes to digital channels. So some segments, obviously very high demand for digital channels, where the others are extremely low. The strengths of the relationships also differing a lot across these segments, as well as their willingness to pay for value-added services. I think another critical element here is the willingness to share data. And as we are moving more towards data-driven financial services, getting customers on board to share data in exchange for value will be a critical thing that banks need to get better at. I also wanted to talk about the ecosystem, which is clearly or has been a big priority for financial services organizations before the crisis. And to some degree, the ecosystem will also be able to support financial institutions in delivering this more segment-based channel propositions. Because, for instance, it's through PSD2, the customer will have the choice of the mobile application they want to use for doing mobile banking, for instance. They don't have to use the banks any longer if they don't like it. But obviously, there's a big risk that this might also disintermediate customers from their financial institutions. So banks should not really, this cannot be an outcome that banks want to. So our big recommendation here is really that they should go out and innovate and build better channel propositions themselves. And they should also be looking at the ecosystem much more as an opportunity for them to innovate business models and to open up new revenue streams. And this is what this slide is essentially talking about. IDC has built this data model where we've kind of looked at and identified 60 open banking use cases where we think banks have a business case. And we modeled those use cases from ground up to really come up with an idea of how big is the opportunity in ecosystem banking for end users or for financial institutions from a revenue perspective. And as you can see, there is a lot of change happening. It's growing into a sizable business. For EMEA, we see that the CAGR is already up around 8% over the next 5 years. And this will mean that by 2024, something between 5 to 10% of total bank revenues will be generated through those new ecosystem business models. And that is quite a sizable amount. And banks who miss out on building this will obviously face some challenges as we further proceed into the digital era. What could those digital banking models look like? And we have also split down those use cases I was talking about into different clusters. And I think the biggest opportunity that we see is around data monetization. We have seen a couple of banks, such as BBVA, for instance, trying to build out APIs where they sell socioeconomic data or payment statistic. At the moment, not for monetary gains. I think they still want to get users of data accustomed to use the data, but obviously the goal behind it is to monetize that data. And I think a couple of other organizations, such as Deutsche Bank, is also building out massive API libraries really to build new value-added services that they can provide to the market. The next biggest is around proprietary platform services. So the bank allowing third parties to use their platform to distribute their products or to distribute services to supplement their own offering. A really interesting opportunity is what we coined anything as a service, or X as a service. And this is really the bank rethinking their operating model. And instead of providing products primarily to the market, they become a service provider to the market. And a good example for that, that's already quite popular in some markets, is banking as a service. So a bank with a license is going out and provides the infrastructure, the operations, and the bank license to a third party, which could be a telco, could be a retailer, to allow those customers to run financial services with their customer base. Obviously, banking as a service is a very high level, but you can really drill that down to quite a specific solution horizon as well. So treasury as a service is a great example. The bank, the corporate bank, goes out to the customer and manages their treasury operations on behalf of the customer, taking on the day-to-day activities and really helping customers that way optimize and streamline costs in running this business by themselves. Other opportunities around data partnerships, external marketplaces, and then to a lesser degree also transaction and account services. So in essence, what we are really predicting here is that the ecosystem of providing financial services will become a lot more diverse, and a financial institution cannot in isolation really deliver these great customer experiences without the support of the ecosystem. Plus, they may lose out on a big opportunity to diversify their business model for the digital era. And last, I wanted to touch on the importance of getting smarter about credit decisions. Clearly, COVID-19 has shown impressively how quickly circumstances can change and how quickly traditional lending models might quickly run out of relevance when it comes to an external shock like we have seen over the last couple of months. And that means we need to become smarter about and more open about the data and the factors that go into our lending models to really move towards smarter decision. And that increasingly means bringing in external data, enrich our own data with more information to end up at smarter models, and also to cast a wider net of different data points that we factor into our lending models. To me, this transformation ultimately boils down to 4 key components. The first one is more a technology one. It's about bringing in the power of predictive. So investing in new technologies to build more advanced credit models and enable quicker credit decisions, and use new technologies such as machine learning and artificial intelligence to optimize and refine those models and generally become smarter about it. Second, it's about model rebuild and management. So that means instead, I think a lot of the traditional models that we are having, they still remain valid, but we need to enrich them and we need to get smarter about how we use different models to come to smarter decisions. So that means improved model governance, smarter, more optimized selection, optimization of credit models, and also increasingly bringing external models that have been proven to work well. I just think of how, for instance, in India, organizations are looking at mobile prepaid top-up data to make decisions on customers that do not have a traditional banking relationship. And I think this is the kind of thinking that we need to bring in to really modernize this area. Third, and I think that's probably the most essential one, is the use of new and open data. So look for new, more diverse data sources that also come from the external world, whether that's from the customer itself or from the ecosystem, whether that's ERP data or cash flow forecasting or client behaviors, or also looking at who are my customers' customers to really build more reliable data and to make smarter predictions about how external shocks will affect the business of my customer. That goes hand in hand really with not just using that external data, but also enriching your internal data and models with that external open data. And lastly, it's about getting smarter about how you price risk. And I think we have been talking about risk-based pricing for a long, long time. Yet still, relationship managers have a very firm hold over pricing in terms of credit. And I think this is something that organizations need to become more disciplined about, to really have an algorithm, have a data-driven pricing mechanism instead of a human emotional type of pricing strategy. And I think with that, we really see how already today, or we predict how organizations will be using a wider array of data to make smarter decisions. But it is a difficult transformation because we obviously see some headwind from regulators here. They are increasingly, or their utmost priority is obviously to ensure ample credit in the market, but they also insist on explainability of credit decisions. And I think in the past, this has often been handled as mutually exclusive with automation of credit decisions, which it doesn't have to be. I mean, just because a machine is making a call doesn't mean that cannot be explained to the customers. I think this is an area where we obviously need to work with the regulators to really convince them and make decisions explainable to customers when they don't get a credit approval of credit. With that, I wanted to end my presentation for today and in quick summary, take you through the most important messages of today's presentation. So first, European FSI are still bracing for the fallout from COVID-19, but we see how they are gradually shifting from business resiliency towards acceleration and preparing for the future that's coming after the pandemic. How do they future-proof their infrastructure, and how do they move back from those tactical investments that we've seen over the last couple of months more towards strategic transformation drive that really builds the right foundation for what is needed in the future. Second, it's really time to rethink how we go about digital and seriously take digital all the way by rethinking also the channel experience and not just do cosmetic touch up to certain channels, but it's really about delivering a good experience to all customers. And that has to be built on their specific requirements. We believe that the ecosystem and data will play an important role to enable this transformation, but ultimately it is really about the financial institution as well to make the right decisions on delivering a better customer experience and delivering the right support and engagement strategies to address specific customer segments and move away from this one-size-fits-all approach. Third, a key transformation towards a data-driven bank will be lending. And I think, if anything, COVID-19 will have accelerated the transformation of this very traditional business. There are a lot of roadblocks on the way that we need to get regulators on board. We need to get partners on board. We need to get customers on board, because ultimately it's about finding that balance between sharing data and getting value in return. And this is really something that we need to get better at. Explainability will remain a key concern for regulators, so that is something that will have to be addressed. But I think we are here at the beginning of a very interesting transformation. With that, I want to end today. Thank you very much for your attention. I hope I answered some of your questions and gave you some interesting thoughts. With that, enjoy the rest of the conference. Many thanks. Goodbye.
Hello, everyone. I'm Antoine Larmanger. I'm a technical director at the Office of the CTO with Google Cloud. And today I'd like to talk to you a little bit about a few trends that are taking place in the financial industry and especially in the banking industry. If we look at financial services and especially banks are facing unique challenges that few industries have faced so far. So first, a very tough economic environment, increased pressure from the regulators, new expectations from customers, new technologies that they have to adopt, but sometimes they struggle to because their internal organizations are not adequate. And we're going to look at all these aspects and see what is the best path for them. And first, markets are, and that's something that is commonly accepted now, the markets are increasingly complex, volatile, and uncertain. With the crisis COVID has shown that almost overnight, a situation that was once seen stable and reassuring can change dramatically and completely. Investors and financiers, they don't really like uncertainty because uncertainty lowers levels of investment and accelerate crises. Today's interest rates are extremely low, and given the economic situation to come, it might be that they have to stay low for some years and for the foreseeable future. So banks will have to find new ways to get to profitability, to get to growth, and new ways to innovate and attract new customers, and competition will increase. Second, customer expectations. And what we see on the market is that customer expectations on banking is changing at very high speed. Banking has become fully mobile, and payments, which once formerly played only kind of a limited commodity role in banking, they are seeing their role increase massively. Everybody's talking about payments. We see a lot of acquisitions in payments. So this is becoming a part that is being more and more critical. Industry disruptors like neobanks and online banks, they've taken an approach to focus primarily on the mobile experience and on price. And they don't really have to deal with huge mainframe and legacy systems. So that gives them an advantage in speed, in agility, and in innovation. Since the crisis in 2008, regulation has also changed in the market, in the banking market. First, bank compliance costs jumped, and costs related to increased regulatory pressure now take a big chunk of banks' IT budget. Problem with this is that that really causes a real problem because IT budgets are stable or is even sometimes slightly declining. So that doesn't leave a lot of room from a budget perspective for innovation. So this kind of intensified the intensified regulatory environment that many banks and financial institutions are in, it comes from various parts of the business, and they cover many different activities. Regulatory reporting has become more and more complex and needs to happen more frequently, if not in real time. As we see, for example, for liquidity reporting, fraud and anti-money laundering monitoring has led many, many banks to hire a lot of controllers and risk managers, and failing to comply here is not really an option because you can be subject to fines and everything. So regulators today are more and more demanding. Incumbent banks, they know how to deal with an intensified regulatory pressure, but the neobanks, they now start feeling the pain the hard way. While some of them might have neglected the regulatory aspect in their business proposition and in the way they are organized, they are reminded every day now that compliance is not negotiable. And incumbent banks, on the other hand, know how to deal with an intensified regulatory pressure, but neobanks now start feeling that they have to comply. In Europe, we also see that the European value propositions are picking up. What does this mean? It means that because there's a kind of a unified banking landscape across Europe, because of these unifying banking market practices, but also because of a relatively leveling customer expectations across European countries, there are fewer and fewer reasons to have a different banking application for every country. Why should you have a different app in Lisbon, in Paris, and in Rome if the features and functionalities that you expect are pretty much the same, except for the language, of course? So that benefits new entrants and new neobanks, because from the very beginning they have built their value proposition around multilingual, around a single proposition across the countries, multi-tenancy, etc. And that puts a lot of pressure on incumbent banks, but because they have now to centralize, to unify, and to consolidate their operations on a European basis, if not worldwide, but mostly on a European basis, where there is more of a unified EMEA landscape. Finally, banks hold a lot of data, a lot of personal data, and personal data has to be protected, has to be encrypted, has to be kept secure, and it cannot be leaked, it cannot leak, and the regulator is very adamant at making sure that it doesn't. On the other hand, personal data comes with a wealth of information, and like customer purchase behavior, and sometimes it can be tempting for banks and advertisers to use this because it creates large opportunities that even some customers might want to benefit from. But it also leads to large issues, regulatory issues, reputational issues, legal issues, and so on and so forth. And not to mention the difficulty that many financial institutions have to manage, control, and govern their data. So we do believe that there is a huge amount of data that is currently untapped and not organized, not governed, that there's a huge potential there. What do customers exactly expect? What we like to say at Google is that customers like to be delighted by novel and personalized experiences. Let's take, for example, onboarding. Onboarding is a key example. This is an area where many incumbent banks struggle to provide kind of an end-to-end, straight-through process, straight-through experience compared to a neobank. Only a few numbers of traditional banks allow their new-to-bank customers to onboard automatically and to open an account, for example, without uploading tons of documents and or even visiting a branch. Here, there's a clear gap that can be filled by incumbent banks. So there's a this clear gap and a kind of a differentiating factor with the more recent and modern banks that they've managed to close. So, for example, a great KYC experience combined with a good account opening journey is a clear area that banks are now increasingly focusing on. Compliance and regulatory pressure comes from many angles. We already talked about increasing pressure on fraud, on privacy, on money laundering, but it's also to be expected that new areas of regulatory burden will come in the future. And it can come fast and take a significant part of the IT budget or the innovation budget of existing banks. Dealing with legacy cost is also a huge problem with banks. Whether we are talking about mainframe or legacy software, for dozens of years, banks have tried to modernize their IT systems. Sometimes they've postponed this modernization. They've been trying to get out of the mainframes, but it is super hard. And it is hard because the business logic hidden in these legacy systems is hard to uncover and migrate. But there are ways to do this, and it's becoming more and more important to really tackle that issue. New technology and innovation will, of course, come from opportunity in machine learning and artificial intelligence and smart analytics, but firms will need guidance on how to start with this. What we believe is that instead of starting with hiring armies of data scientists and the data specialists of algorithms, they first need to understand and play with their existing data, and they need to start using tools and services that will allow them to start experimenting with AI and ML with little, if not zero, knowledge of complex algorithms and deep learning and everything. Start with your data, start with data sets, and try to apply algorithms that come out of the box rather than trying to build very complex systems that are hard to operationalize and hard to master. So that will require to focus on making sure that the data is there, the data is analyzable, and the data is available. If we focus on a few other things, so let's say we talked about onboarding as a way to delight our customers, because it's the first impression that the bank gives with a mobile experience. But another area of customer delight is also a way to manage. On top of customer delight, there's also a way to delight the customer intimacy or the customer relationship you have with your users. And it's not just through mobile, but it's also through other types of channels. So the multi-channel experience is something that we believe a lot in, because it's not just about mobile or web, it's also about, for example, the phone and the call centers. The ability to manage big call centers is going to be key, and AI is going to play a big role in this. So we do believe that customer call centers will use AI more and more. And virtual agents will allow human agents to focus on value-added tasks rather than things like, I want to reset my password, how do I reset my password, and things like this. So we will see more and more virtual agents. They are going to be ubiquitous in the banking relationship with customers. Conversational bots will be able to filter a lot of calls from customers to let agents focus on the most complex calls. And this is not just a cost exercise, but also a user experience improvement. On risk management, things are also changing rapidly. New architectures using streaming technologies are being more and more real time. You will see fewer and fewer batch-based architectures and much more real-time architectures. This will also be combined with AI and ML models and machine learning models that have been previously trained, but that can be used in real time for commercial activities and for risk activities. With AI ML, loan default or credit risk predictions will be more accurate, but this will take time as the models will have to be trained appropriately on the right data sets. And getting the right data sets to train your models will continue to be the most challenging part. I'd like to focus on the last point, which is open banking. We do believe a lot in open in Google, so we believe that, and we see that the regulator has tried to open up the bank infrastructures through PSD2, and we do see that APIs are now available through PSD2 and open banking, that banks will try to be part of ecosystems, of marketplaces, of open platforms, etc., etc. And we also believe that the world open will also be in the open source model. So using open source in your IT infrastructure is going to be something that's going to be more and more important. So let's summarize a bit what we said. So we said that because the banks will be in a kind of a critical situation from a margin perspective, they will have to introduce new products. So innovation will play a key role there. And to do this, data and artificial intelligence is going to be key to better manage risk and to make more accurate prediction, to improve operational efficiency, real-time and new streaming architectures combined with a high degree of modularity in your IT architectures to introduce more products more frequently will generalize. And it's only the architectures that will be flexible enough that will allow you to create new products in an agile way. So the cloud, of course, will play a big role there, because with the cloud, you can only pay for what you need, and you're not going to have to reinvent the wheel each time you want to create a new product. And if your product doesn't work, you can kind of stop paying if you want to decommission an application or stop an experiment. We have numerous examples of this in Google, where we say, where we can help customers achieve some of these challenges that we mentioned here. They vary from customer experience, new applications, the use of AI, ML, modernizing your IT legacy systems, migrating your mainframes, introducing platforms and API ecosystems, etc., etc. But to conclude, just a few things to remember is that the cloud will play an important role because it's an enabler of innovation. You will use the cloud because you will need more flexibility. You will need to access to more innovations that you couldn't access without it. And it will allow you to build new architectures that are different from traditional infrastructures. You will have to make sure that your new architectures are reliable and secure, which the cloud will help you achieve, because the regulator will be more and more demanding on privacy, security, and compliance. You will have to use AI and ML not only to better predict, but also to enhance customer delight, customer experience. And you will have to create a modular and flexible architecture to improve your time to market, but also to improve the time to initiate new projects and new innovations. And the cloud will also allow you to pay only for what you actually need. So that's a lot. Thanks a lot for your time. Good luck in your endeavors, and goodbye.